get going here. So, welcome everyone to another exclusive Apollo webinar. Today, I'm lucky to be joined by Ben Musgrave from Velocity Capital. Thanks for joining us, Ben.
Well, thank you very much for having me. It's very generous of you. I hope I will meet the expectations.
No doubt, no doubt. Today we'll be discussing kind of Ben's professional journey, taking a look into Velocity Capital, and hearing some notable stories, success stories that they've been involved in, before exploring, some more common pitfalls founders fall into when reaching out to VCs, and wrapping up with some insights into the current UK VC landscape, and maybe some predictions for the future. So we'll see how we go on time, but we may also have some time at the end for some questions from the audience. Otherwise, we'll be obviously connecting Apollo with Ben's details, so you can always reach out to him in person after the session. But yeah, Ben, without further ado, first of all, you've got one of the most impressive CVs I've ever come across. Can you share with us a little bit about your professional journey, and I guess key experiences that shaped your career before joining the VC world?
Yeah, unfortunately, that's probably a testament to my age. But I'll take it if I can get it. I spent 20 plus years in investment banking, largely in bulge bracket entities. I was working through corporate finance, research, and then finally in the equity related, and working largely in Asia. So I had a good experience in very different management cultures, and I worked across a wide range of company sizes, and that's where I began to get interested in the smaller upcoming venture type areas of the market. And I think really, it wasn't really an epiphany. I always thought that I was getting a little bored. I was not very corporate in my nature. I was quite contrarian. And during the COVID, I had a sort of like many, a self-audit, and decided that I wanted a new challenge. And so I began working on the operations side of pre-seed startups, which was someone who is contrarian and needs to develop new skill sets, was a godsend. I have to be honest, I'd say my experience was mixed during that period. Depending on the founders and the concept and the cash flow, it was quite rocky at times. But I got the call finally to join Velocity Capital in its business development and investment committee, and I thought the timing was perfect for gamekeeper turned poacher. So that was really the background for me, going from that sort of institutionalized side of life into a very much more dynamic area.
Yeah. No, and it sounds like, I can hear in your voice that you really have a passion for this kind of industry, and I think you mentioned there, obviously COVID was that kind of maybe a turning point, or a point of kind of reflection, where you kind of maybe assessed and thought, maybe I want to be doing something that I guess I'm more passionate, that feels like a better fit.
Yeah, I don't regret it for a second. It was it's exactly what I wanted to be doing. I wanted to explore new commercial ideas, technologies, and customer interaction from a contrarian and outlier perspective. VC is an outlier industry, and it's also where problem solving is an important facet of the experience of building and measuring and learning. And it's a perfect environment for anyone who's intellectually curious. And you're definitely outside your pre-existing comfort zones. I think something that applies inherently to founders as well. So, I made plenty of mistakes initially with my engagement with both investors and target startups. And that's very much the nature and the catharsis of the industry. Because, whilst the learning curve is steep, venture capital remains the most effective way to access future market leaders and disruptors, and being intimately involved in that journey with the management of these companies is a very satisfying job to have overall.
Yeah, no, I'm sure. And you mentioned you're part of the business development team at Velocity. Can you expand on that and kind of explain what I guess your main responsibilities and roles are?
Yeah, we're trying to develop the investor base significantly, because I think there has, obviously since 22, which is when the market began to fall back considerably, there has been an absence of typical investors, IFAs, high net worth individuals looking for tax mitigation. And the business development that we are now looking for is to look for proactive clients, look for investors who are looking for higher adjusted returns, but that aren't doing it on the basis of end of fiscal year or HMRC for a lot, SEIS and EIS is a very important facet of this business, but we are looking for consistent, sustainable, better channel pipeline for investors to come into this market, and it's growing measurably in areas of private office, family office, endowment, foundations, and that's what we're looking for, because we can get a much more credible track of investment for our companies.
Okay. Yeah. No, understood. And I guess more on the lighter side, Ben. You said that this VC world kind of might have felt like a better fit for I guess your experience, your personality.
Yeah.
What kind of excites you the most about your work that you're doing with Velocity at this point?
I'm always humble meeting the founders and management of these companies, because they're very dynamic and they're passionate, and their vision is obviously very clear, and they have great conceptual ideas on what they want to develop, what sort of marketplace they want to attack, and it's that entrepreneurial spirit and dynamism which is very attractive. It's very contagious. You want to do the very best you can to enable that, and that's why I suppose it's a much more immersive sort of job, as opposed to working in investment banking.
Right.
It's much more standoffish. There's much more siloed involvement. Here, you pick up the phone to anybody and everybody, and you get people involved, and people don't care if they're slightly put out by the fact that it's got nothing to do with them. It's not their area of interest or their area of investment. They will still join in conversation and narrative with you, and that's what makes it interesting and a very different environment from what I'm used to, and it's great. It's lovely to have that.
Yeah, no, I couldn't agree more. I think in this industry, whether again it's on the VC side or the founders and the startups itself, you have to be a little bit mad, I guess, to be a tech startup founder, and that just makes it more exciting, because you never know really who you're going to be running into or speaking to.
Yeah, but like I said, they humble you. They come out of left field, and they surprise you with their ideas and their thoughts and their understanding of things that we would find as a normal pattern. They're looking for something which goes against the grain, something which is not normal in terms of pattern, and that's a very energetic environment to be in.
Yeah, no, of course. All right. So then going more into Velocity Capital and I guess your portfolio and preferences on that end. So can you give us a little bit of an idea into the type of companies and maybe industries that Velocity Capital typically invests in?
Absolutely. Velocity has always sought to marry sort of traditional VC with the expertise in marketing and customer-facing evolution. Sorry, that's very jargony. But it basically, it comes from the founders and the entrepreneurs of the Velocity business itself. The one is a former marketing director of Red Bull, the co-founder of BNB and Purple Bricks, and the co-founder of Freud Communications. So with immense experience of B2B, where the travel is similar to consumer, and online marketing will make a key or difference to growth and scale. So 60% of the Velocity management have founded, scaled, and exited businesses. I think it's only about 8%, to be honest. Maybe I've got that wrong, but don't shoot me. It's only about 8% of other VC fund managers. So ultimately, I'm part of the investment committee, and we are sector agnostic. We love things like marketplaces, subscriptions, SaaS business models. Realistically, and I have to be honest, because they deliver better multiples than exit.
Yeah.
But the firm's vision is essentially to invest in resilient, talent-led, high-growth tech-enabled businesses with digital acquisition models that have the potential to scale internationally. That is the best all-encompassing sentence I can give you for what we're looking at on a day-to-day basis with the pitches coming in.
Mm-hmm.
So I mean, that thesis is robust, but it's flexible. It reflects what is a multidisciplinary team, which has affinity for founders with domain expertise, with entrepreneurship and transparency. And my experience suggests Velocity is unique in that VC world because they are passionate about new ideas. They are passionate about innovators behind those ideas. And they are a marriage of finance to the creative mindset. And they can cherry pick to satisfy that value proposition.
Yeah, really interesting. And I completely agree with you that, yes, you have to have those frameworks and I guess preferences when, assessing potential investment opportunities, but it's also, it's a very case by case kind of situation, right? So I guess on the timing of things, when would Velocity typically get involved, or at what stage in the ventures kind of journey?
Well, I mean, as I said, given the tax mitigation factors, we are pre-seed, but we're mainly seed to Series A. Mm-hmm. We like later stage companies purely because we can get a much better and clearer path to scale. We have a much clearer path to go to market. And we like to become strategically involved in the companies at that sort of stage. We like to have skin in the game from our own balance sheet. And whether pre-seed or seed to Series A, it's again to just have our capacity to help and nurture younger, dynamic, and differentiated founder management, essentially. Mm-hmm. So, we have 68 companies in the portfolio. It's an eclectic mix of D2C, B2B businesses, which facilitate commerce. That's a pretty sort of ill-defined expression. But I mean, for example, we have Patches. It's an automated AI triage system. Mm-hmm. Some of you may be familiar with in an NHS GP context. We have wellness companies such as Fussy, UK's largest and largest and highest rated natural deodorant range, with plastic-free combustible refills, compostable, by the way, that was the expression, that you may also know from Dragon's Den and your local supermarket. And finally, we have Scene, which is a almost or soon to be fully fledged B2B SaaS model, delivering data-driven video at scale for organizations. And it's the real user CRM solution to diminishing returns from digital online marketing and the free-falling customer engagement pipeline. So, it is quite a diverse group. Whether we have fintech, medtech, martech portfolio constituents, these businesses can all be transformed and differentiated by online growth, and that's again the factor I keep coming back to in that respect.
Mm-hmm. Oh, brilliant. And you mentioned obviously that you guys are kind of industry agnostic, right? And again, there's no kind of one set in terms of whether it's pre-seed, seed, or Series A. Obviously,
go ahead.
Obviously, the earlier, I guess, the venture is, that mentorship and network, it can be really, really crucial for the kind of the long-term success. So how would you guys kind of leverage, or do you guys leverage your network to support, your portfolio companies? And I guess what kind of mentorship, or what does that mentorship look like, if at all?
Well, I mean, essentially, we utilize the network, which is the portfolio umbrella, but we also utilize the business context, because although 60% of us have come from a founder entrepreneur background, the 40%, the rest of us come from legal, industrial, finance, and we have a lot of partnerships and a lot of contacts in very different areas, which will enable often some of the early startup managements to get a better handle on the operations side, on the commercial or the tech side. And those are the sort of partnerships which you may call it mentorship, but it's really just engaging them. Often they work for free. I mean, it's a case of what mutual benefits can be gained from that arrangement, and often there are mutual benefits. So that's where the relationship and the network exists and can be synced, but it's not just within the portfolio. It exists within a group of a network of partnerships that we have, courtesy of our different backgrounds in various industries.
Yeah, and I guess that's quite a unique aspect to Velocity, in terms of when you're looking at some of these more established VCs, it's very much capital and then I guess pressure, right? Whereas it seems a lot more supportive and I guess transparent, and really looking at I guess the individuals that make up Velocity as a whole.
I think that's the big differentiator, as I found. I mean, having worked in startups and dare I say it, met a lot of charlatans or someone who's just trying to bang the square peg into the round hole.
Yeah.
It's made a huge difference to work here and see this. It's almost like a corporate paternalism. That they really want to be involved. They want a seat on the board where they can. They want to have investment in the companies. As I said, it's like an immersive experience because they want to direct where they want to utilize that experience and that knowledge and that industry background to help these companies, and they can do it, and they've successfully done it already.
Mm-hmm. Yeah, brilliant. And you touched on this, Ben, that, Velocity is kind of credited with being one of the UK's leading VCs in B2C and D2C businesses. Yeah. Could you maybe highlight an example or two of companies in your portfolio and what you believe kind of were the really key factors to the success of that venture or that investment?
Yeah, I mean, I'd like to sort of talk really about companies which are at the sort of cusp of exit rather than the exits we've had. We've had 7 exits outside of the fund. We've had 3 exits inside the fund. But I thought it'd be interesting just to talk about companies which are still within the portfolio. But we are at the point where we're looking at a fairly considerable multiple for exit. And one of them is Outsmarted, which is a physical board game married with a digital app. So it's like Trivial Pursuit, but dragged into the 21st century. The first investment we made was when the company was doing about 1.1 million revenue and on about a 3 million valuation. And then we invested again, I think the next year when it was doing about 1.8 million and was on a 6 million valuation. And last year it did 8.5 million revenue, and it has an indicated value of 24 million. So the company is looking to do about 15 to 20 million revenue in 2024 and be profitable, and is now scaled across 11 geographies. And that's a perfect example of what we've been trying to generate and trying to nurture within this within the process of us bringing on this company. So the exit strategy for a company like this is obviously to sell to Hasbro and Mattel, which normally buy businesses at anywhere between 200 and 250 million. So we've always got this plan for the founders and for ourselves, and where there is a meeting on the mind. We're very happy the founders to continue on with their trajectory, but we always like to have the discussion so that we know where we're at in terms of progression. And that would be a sale to Hasbro or to Mattel in that example. Or we have another company called Swoop. Again, it's at the cusp of exit. And this is really a supermarket for SMEs in terms of them accessing funding landscape on better terms. I mean, the founder is ex-KPMG corporate finance founder, and a non-executive director of Berkshire Hathaway. So, they're currently growing through partnerships, and this is where we have the relationship with Sage, and that produced revenues. That company produced revenues last year of about 5 million. Now with the Sage partnership, they'll double that revenue growth, and obviously Sage has always acquired all of their last partnerships. So again, we're keeping our mind on that trajectory and that exit for everyone to be involved in keeping on plan with where we're going in the final process of developing the company.
Right. No, understood. Okay. And obviously we looked at this before in terms of, that technical skills are really crucial for a founder, right? But I think that, what I've noticed even in the last year or so with Hyper is that the founder's soft skills can really be a differentiator and I guess the ultimate success of the venture. How do you evaluate soft skills of founders and their teams when you're looking, whatever stage it is in the investment process?
Yeah, that's quite a difficult question. I mean, we take a very holistic viewpoint, i.e., we try and get everybody to meet the founders when we're at that stage. We want to assess their quality of management capability, their focus on detail, the time spent on the discovery process, how much degree of operational, commercial, and business experience have they got, and also the capacity to learn from their mistakes. It means essentially they have to be very aware as individuals. They have to recognize their faults. They often have to bring in other people into the management, which complement them as opposed to just duplicate them. And so, it's a difficult process, and we haven't always got it right in the past, but we think we're pretty good at it now, because you ask the right questions, you ask about history, you ask about focus, you ask about what they've been doing, how much time they've been spending outside of the building, just looking at potential market or customer base.
Understood. And I guess just on this point around the parameters and the things that Velocity really look into here, as you said, there's no one cookie cutter approach, but I guess putting the idea itself and the team aside, when you're looking at like the unit economics of a venture, again, given whether it's pre-seed, seed, or Series A, what in particular are you looking out for? And can you explain what I guess gets you excited when looking at those unit economics?
Yeah, I mean, when they're first coming to us and when they're describing their forecasts for revenue or market size or anything of that nature, it's fine to have lots of data points or expressions of interest or traction pointers. But what we're looking for essentially is really real user solutions which are developed in a capital efficient manner. So capital efficient growth is the strapline here, because as you may know, 2/3 of all the startups will probably fail, and most of them will probably fail because of cash flow. So capital efficient growth, the desire for profitability and the expected timing for profitability, the capacity to problem solve, and the clear and coherent strategy they have is very important. As far as metrics go, I mean, getting to the data room and going through the process of exacting management to come up with lots of data, lots of detail, is part of the process. Visualizing KPIs, whatever you want to call it, but it shouldn't be an over quantitative process. I think is the best way of describing it. I'm not too sure if that's really explaining
definitely
the process, but we all know how to read business models, financial models, data sets, metrics, and that's fine. But we want to know more than that. We want to know how the build is being worked out, how that is retained within this capital efficient growth. Is that growth sustainable, reliable, replicable? So, I mean, those are the sort of factors we are trying to engender on a more qualitative basis.
Understood. Yeah, no, I think that makes a lot of sense, and I think there's definitely a susceptibility for founders to, I guess, worry too much about one thing in particular, and this is what I wanted to kind of touch on here, Ben. Is have you identified any common mistakes or seen founders where, when they're approaching, whether it be velocity or just seeking investment in general, have you identified any common mistakes or trends on that approach?
Yeah, I mean, I don't want to go into a long list.
No, you don't have to call anyone out here.
I mean, there's the common mistakes are, I suppose, one is valuation. It's often too high because it's dictated by how much they want to raise and fearing the dilutive effect. And it's one of those chicken and egg issues that they will push for a higher and a higher valuation, which obviously allows them less dilutive effect. But it's not always the best process. They should take some advice from the VC in terms of knowing what the market's prepared to accept, knowing what the investor base is looking for in this type of company. I think there's also, if I point to, would be impatience. I think it takes time to raise money. It's taking longer because of the macro factors which have affected the market since the first quarter of 2022. It's best to align with sooner and rather than later. But I think that sometimes it's important that we can get. We have another string to our bow here at Velocity. We have Velocity Juice, which is a debt financing arm, which is a very useful adjunct to Velocity Capital, which enables companies to be financed for a large part of their marketing or their operations without having to go to investors and receive a more diluted outcome. So I mean, this is one of the ways we get around it. But the situation for most companies coming to VCs, the experience is one of rejection, and that shouldn't hold them back. I think that leads on to the third point, which is the reasons for going to a particular VC. I think it's tended to be a spray and play approach by many founders, where they're just looking for the best terms or the largest amount of money or the best possible sort of group that's assembled around them. I think it's you need to pick VC managers for their particular skill set and for their expertise. I think you look for companies. If you're a founder, you should be looking for companies in that VC's portfolio where the business model is similar to their own, or where there are natural synergies in amongst the portfolio that's there in the umbrella of that VC. I think as I said, the square peg into round hole factor can often lead to terrible results for those who go to the wrong VC.
Yeah, no, I think, and that comes down to, again, I guess the due diligence, the understanding of what you as a founder need in order to scale. So it's kind of making sure that you come across as someone that's a really efficient operator, which is something that we always say at Hyper, right? Just making sure that we're painting founders in the best light possible, right? And really being, I guess, as stringent as possible about who you're getting into bed with from a cap table perspective as well for the long run.
Yeah, absolutely. I mean, the clarity of information, the ability to sell yourself, the clear sense of purpose, the passion. I mean, these are all, as I said, these are the things which tend to humble me when I meet founder managers. But they're also sometimes lacking. Occasionally there's a solution for a problem. Or a solution looking for a problem, and there are very obvious things or very transparent things which would cause us to sort of back away. But I think the sort of three factors I give there, as opposed to a long list which would probably get people upset, I think it's probably the best way forward.
Yeah, no, I agree. And then I guess, Ben, looking to the future, right? You mentioned obviously how this market kind of did take a bit of a hit back in 2022, but I think, what's encouraging is things are looking up, right? In the first quarter of this year, global venture capital funding grew approximately 16% quarter over quarter, reaching around, I think it was 66, 67 billion pounds, right? So I guess in that regard, what kind of emerging trends or techs are you currently exploring from a velocity kind of standpoint?
Well, I mean, you're right. I mean, the market is recovering. It's recovering fairly slowly, and it's not really surprising, I think, given the impact of the first quarter of 2022. I mean, that's largely geopolitical, along with macro. I mean, obviously interest rates, inflation and interest rates expectations skyrocketed, and we've seen the result. But we are seeing the recovery take place. I mean, it's still very thin in terms of liquidity and exits. Often, public markets will have a big effect on that because it just lessens the viable routes for exit as a whole. But the market is recovering. In the second quarter, it was probably up about 9% or so year on year. We are seeing new investors coming to the fore because there has been a growing interest amongst family offices, private offices, endowments, foundations to look for higher risk-adjusted returns, and often those type of investors will have very heavy skews towards property and real estate, and they're looking for alternative investments. They're looking for private markets for that portfolio diversification. And as I said, there are some very viable and some very exciting business models that we can recommend to them from a co-investment or from a partnership investment standpoint. So, the market is recovering. I expect we'll probably find that the existing investor base for EIS or SEIS is probably expanded rather than there being a lot more new individuals into that market. But it's the private market side in amongst those newer investors, which is probably going to take us forward from this point. And we're looking at that very much from a new investor and client landscape.
No, understood.
Sorry, go.
No. Go ahead. Sorry.
No, you were asking about trends. I think, when people talk about corporate governance within these companies, I reach for my gun largely because it's, you can just see everyone's eyes rolling when they hear that. But I would say that it's not really corporate governance. It's making free flow of information within the firms. These are essential elements which are changing the landscape for these companies. If we're talking about different sectors coming to the market in terms of VC, I mean, obviously, crypto died at the end of 2022, and then what we've seen is the emergence of ESG. Obviously, climate tech has gone crazy. AI has gone crazy. Some of the deeper tech formations are now coming to the fore. But, I think that we will be investigating all those, but we will still be investigating MarTech, MedTech, and FinTech as well. What we'd like to see is within our area or sphere of expertise, we like to see generative AI as a tool to be utilized and not as an investment target per se. That's where companies, where the new innovations have developed an infrastructure for what we've seen in terms of the consumer markets or consumer online. We now have new ideas generated. The next gen ideas are going to come from that infrastructure. So AI is just essentially part of that, and there will be lots of new concepts, I think, that will develop on the back of that. But at the moment, everybody is perhaps banging the drum a little too resolutely on deep tech, climate tech, AI, etc. Whereas I think as a contrarian, I don't want to just jump on the bandwagon.
Interesting. And you mentioned that maybe banging on the drum a little bit too loudly. What could you identify maybe an underappreciated sector in the market that you think, maybe personally or from velocity standpoint, that you think?
Yeah, I think that medtech is a very important development. If you think about telemedicine, and if you think about this country, especially in terms of the sort of business model, the economic viability of the NHS, medtech is a very important and very essential development that's coming through a lot of new startup companies. As I said to you, Patches is one example where they've established an automated AI-driven triage system, which is used in GP surgeries to allow to eradicate the backlog in terms of patients being seen by doctors, and it's very effective, and it's extremely attractive from a pricing perspective, and it has huge upsell potential. So these sort of ideas, and there are many others in terms of medtech, I would probably highlight just at the moment. Maybe it's dear to my heart. I used to be a healthcare analyst, so maybe I'm just biased.
Yeah, exactly. But it's interesting that, and despite things like Brexit and COVID, where everything was very isolated, the UK startup ecosystem is definitely becoming more and more interconnected with global markets.
Yeah.
What's your kind of approach to cross-border investments, or what kind of challenges or opportunities do you see in supporting startups with international expansion?
I mean, it's essential. One of the monikers or the straplines for us is to allow companies or to enable companies to scale internationally, and it's absolutely vital. We had an example of a tech company in Norway where they were managing ticket sizes in the Nordics of about 24,000 per contract. When we helped them set up BD and sales operations into Western Europe, their ticket size went from 24 to 49,000 per contract in the space of about 8 months. So we have lots of contacts, and we have lots of other companies that operate out of European bases. Obviously, the UK VC market is the largest in Europe. It's the third largest in the world, and is probably 3 times as big as, I don't know, Germany and France combined. It's a big market, potentially an even bigger market when you consider the impact of EIS and SEIS, which has been a very useful tool to expand that. But we have to think globally in terms of the companies that we are curating. We will do our utmost, because of the background that we have, in helping them develop that global appeal, or at least that European appeal for the first startup. So and we go to companies that we have had within the portfolio, or that we've discovered from the companies that we have now in the portfolio. So these may be outside, but they're still tentacles of influence and tentacles of synergy that we rely upon to help the current companies we have. Obviously, those companies also have mutual benefit from often enabling their own business or enabling their own commerce through these companies that are looking to expand into other global markets. So it's a vital and essential tool that we hopefully bring to bear for the management of these companies.
Yeah, really interesting. Just looking at the time, I would like to get through a couple audience questions, if you're happy to do that.
Yeah, sure.
So Jamie Richards is asking, he's seeking his next round of funding. They were advised that they needed to achieve a specific milestone, including 50K users, million in net profits, or 3 to 5 million in gross revenue.
Yeah.
He asks, if they were to merge with a business that aligns with their target audience, and this merger enables them to meet the gross revenue target, would VCs consider revenue as part of their platform success? Or do VCs require that revenue solely to originate from the core subscription service of their original platform?
It's difficult, because often when you're talking about merging companies, you're talking about a whole different perspective in terms of management abilities, founder's capacity to develop the idea, foresight of markets. You're basically involving many more people, unless it's going to be a very definitive merger where one side of the management team disappears. Just a bolt-on revenue does not mean that it's the most cohesive, sticky revenue that you might get. And so VCs are naturally going to be a little bit careful about naturally assuming two entities coming together to make one larger entity, and the revenues being significant to meet their parameters is not always the case, and for the reasons I really spelled out, that sometimes customers go, it's not the same company, different people are involved in different geographic areas, so there are lots of pitfalls which VCs will look for if it's a merger.
Interesting. Yeah. And I guess going back to that topic of, looking deeper into those unit economics, what they actually mean, and, seeing, those are really, really important factors. One more, Michael Dalsman was asking, he was speaking with some VCs this week, and they asked a question that he didn't have an answer to. He's asking what's the best way to handle that kind of situation, like to stay open and promise to follow up with that, or to fill in and kind of, I guess, fake your way through it.
No, be honest. So I don't know at the moment, and I don't know because for these reasons. That is also, but also to say it is something that we are actively looking to to be able to detail. I think honesty and transparency is very important, but because most of the time when you're sitting in those sort of meetings, you can immediately tell if it's a fake or if they've made it up, because often something doesn't align in the numbers. So I would just be very honest and say, we have to admit that we don't know the answer to that question, but it is one of the many things that we are looking to address.
Yeah, no, understood.
I think VCs like honesty and transparency,
of course,
more than anything else.
Yeah, I think it comes down again to that the soft skills, right? And you'd rather have someone that's upfront and understanding, I guess, exactly what they're doing and is very, I guess, self-aware in their own strengths and weaknesses.
Absolutely. I think you'll find that a lot of the failures in VC portfolios have been down to fake, have been down to just misdirection and just hyperbole, just basically making out that things are far better than they actually are, or produce figures which suggest that. And I think that given what's happened, over the course of the last 3 years, VCs just appreciate honesty more.
Yeah, no, of course. I think so. That makes sense. Well, Ben, I think that's all we have time for today. I just want to thank you again. Did you have any kind of final words of wisdom or anything you wanted to leave us off with?
I just think the VC market is a very, very exciting. It is the best format to find the sort of market leaders and disruptors of tomorrow. There will be some very good companies coming to the fore because of the sort of innovation that we see in infrastructure, because of the maturing of that innovation. And I think founders and new managements across the board in venture just don't give up, be persistent. That's where the passion is. If you're persistent and almost obsessed about your idea, that will create a good vibe in the first place. And I think that it is a factor that the largest experience is one of rejection. But as it is for so many things in life, it's not a bad thing. It's just agile, adapt, try a different approach. Make sure all the basics are in place, but just keep going.
Yeah. If it was easy, everyone would do it, right? So,
Absolutely.
That makes sense. Fantastic. Well, Ben, thank you again. Really, really interesting discussion. I'm sure we'll speak soon. And thank you to the audience, everyone attending. Hope you found it informative. I hope everyone has a good afternoon.
Well, thank you very much. Thank you to Hyper and Apollo, because you do great work out there on the incubator side. And I only hope that maybe some of what I've said could be of use and of interest. So thank you very much for your time.
No doubt about it. Thanks a lot, Ben.
Okay.
Cheers, everyone.
Thanks,
Bye.
Ben.